Japan is sounding the alarm. Yields are surging. Investors are fleeing. And the country once famous for its low interest rates is now becoming a warning sign for the world. This isn't just about Japan. It's a glimpse into what happens when global markets lose patience with massive debt. Part 1. Japan's bond market is cracking. In 2025, Japan's government bond market, once considered one of the most stable in the world, is showing serious strain. Here's what just happened. 10-year Japanese government bond (JGB) yields have risen above 1.2%, the highest since 2011. Bond prices are falling. Investors, both domestic and foreign, are dumping JGBs at a pace not seen in decades. To most countries, 1.2% sounds low. But in Japan? That's a shock. This is a country that spent years with zero, or even negative, interest rates. Now, the market is waking up to a brutal reality. Even Japan can't outrun its debt forever. Part 2. Why this is happening now. Japan's economy is facing 3 pressure points all at once. 1. A ballooning national debt. Japan's debt-to-GDP ratio is over 260%. That's the highest in the developed world. 2. Inflation is finally returning. After decades of deflation, prices are rising, pushing the Bank of Japan to back off its ultra-loose policies. 3. The Bank of Japan is stepping back. For years, the BOJ was the buyer of last resort. Now, it's tapering its purchases, leaving the bond market to the market. Without the BOJ propping up demand, bond prices are falling, and yields are surging. This is what happens when the government has issued too much debt, and there are too few willing buyers. Part 3. Why the world should be watching Japan isn't just another economy. It's the third largest in the world, and a key player in global financial markets. What's happening there is a case study in market fatigue. Investors were willing to lend the government money for decades at near zero rates. But now, with inflation rising and the BOJ stepping back, those investors want more compensation for risk. This is a glimpse into what could happen in any country, including the U.S., when deficits grow too large and central banks retreat. Even with a strong economy and global influence, there's a limit to how long markets will stay patient. Part 4. What it means for Japan's economy. This bond sell-off has major ripple effects inside Japan. Rising interest costs. The government now has to pay more to borrow money, which puts pressure on the budget. Strained public services. With more money going to debt payments, there's less for infrastructure, healthcare, and pensions. Currency impact. The yen has been volatile, weakening against the dollar and increasing import costs. Investor uncertainty. Japanese households, traditionally big JGB holders, are getting nervous and moving into cash or foreign assets. In short, this is not just a technical correction. It's a fundamental shift in how Japan's debt is priced. Part 5. Lessons for the U.S. and other nations. Let's be clear, Japan has advantages. A high domestic savings rate, a relatively stable political system, the ability to borrow in its own currency. But that didn't stop this sell-off. Now, think about countries like the United States. $34+ trillion in national debt. Annual deficits over $1.6 trillion. Dependence on foreign buyers like China and Japan to fund borrowing. If investors start demanding higher yields for U.S. Treasuries, it could trigger a similar chain reaction. Higher interest rates across the economy. Slower growth. More political battles over spending and the debt ceiling. The U.S. may be the world's reserve currency, but Japan is showing that even powerful economies have limits. Part 6. What comes next? Japan's bond market will be a space to watch in the coming months. If yields keep rising, the Bank of Japan may be forced to intervene again, risking credibility. Pension funds and insurers may rebalance portfolios away from JGBs. Retail investors may seek inflation protection elsewhere. And globally, investors will ask tougher questions about sovereign debt sustainability. Emerging markets could face pressure as global yields climb. Central banks will be forced to walk an even tighter tightrope. This isn't just a blip. It's a structural shift that could reshape global capital flows. Final thoughts. Japan's bond sell-off isn't just a domestic story. It's a warning shot. Even the most disciplined economies can run out of runway when deficits grow too large and buyers lose confidence. If you want to know what the future might look like for heavily indebted nations, just look at Japan. If this breakdown helped you make sense of the noise, subscribe to Finance-Related 101, where we translate global economic events into simple, actionable insights. Thanks for watching. Stay bond-aware.